We've painted a picture that could be summarized with two words: instability and uncertainty. It's this kind of a context that you find a good defense to often be your best offense. We're going to take a couple of minutes and talk about the gold market, why it is still in a bull market even after 10 years, and what some of the elements will be that drive the price higher. We're going to look at 5 things that we think will bring the price of gold to between $2,500 and $5,000 an ounce. We've discussed inflation. This is one of the drivers of the gold market for the next 2 to 3 to 4 years. The expansion of the monetary base over the last 18 to 24 months has been between 119 and 125% here in the United States. It's the same in Britain, even more so, to a slightly lesser degree in Switzerland. What you can expect to see within another 18 to 24 months after that expansion of the monetary base is an expansion in M3, an expansion in the total stock of money and credit, and inflation. So is inflation today's issue or tomorrow's? Investing often is an anticipatory work. What is on the horizon? What is coming? You can't invest in the rearview mirror. We are in a debt liquidation cycle. We have, as we've discussed our time today, too much debt. Private, corporate, governmental, internationally. The picture is the same, and those bad debts are being liquidated. Another element in the inflation story is quantitative easing. The supplying of liquidity to the market, and as a subset to that, monetization, that has been with us through March of 2010 aggressively, and we'll continue to see it. Currently, the Fed's balance sheet is about $2.2 trillion, and that puts their leverage at about 40 to 1. That's a more leveraged balance sheet than Bear Stearns had before their demise, and many of the banks that have been in trouble and in fact foundered in the 2008 to 2010 period. This is where politics gets involved, because the threat of throwing us back into recession, if the liquidity is taken away in the wrong way, too quickly, or at all, we're likely to see politicians encourage the monetary authorities to keep the punch bowl out there just too long. The second element driving the gold market to significantly higher prices is investment demand is now off the charts. What started as a very low-profile bull market in 2001 and 2002 with gold around $252, it's been well advertised by the price move from $252 to over $1,200. As we get to the $1,500, $1,600, $1,700, $1,800 level per ounce, what you find is a growing momentum trade where investors see the price moves, and they may not be aware of the fundamentals behind the market. They may not be aware of the frailties within the stock or bond market as we've explored today, but they do see price action and they say, if this is where people are making money, then that's where I want to be. That would depict a latter stage in the bull market, which we'll talk about in a minute. Investment demand has been increasing because the vehicles that give access to the asset itself have multiplied. We have the exchange-traded funds, which you can purchase gold now as if it were a stock in Switzerland, in London, in Canada, and so the whole globe has access to gold with the click of a mouse. The 6th largest gold holding in the world today is the former Barclays ETF, GLD. Again, the ease of accessibility has made the popularity of the metal that much greater, and I think will drive the price higher still. The other part of investment demand is supply, and we're looking at a crisis in gold supply, if you will, a peak gold scenario, like some have discussed peak oil. The issue is that mine supply has been dwindling, in particular South Africa. South Africa was the largest producer of gold, and they are now a marginal producer compared to what they once were. You are finding new supplies of gold throughout the world. Unfortunately, they're in very politically dicey places. So supplies are dwindling at the same time demand is increasing, and this is the perfect storm, if you will, for price explosion to the upside. Also in the demand equation are countries like China and India, who have long been buyers of gold, and now as countries they're adding to their currency reserves. Many central bankers who have for a long time looked at gold with scorn, with antipathy, with no real appreciation, that all was lost in the last 100 years, are now looking at it and saying, if we don't like dollars, maybe we like euros. Well, with the euro foundering, maybe we don't like euros either. What do you go to that gives you liquidity and asset preservation, that gives you an alternative to the dollar as a currency play, not as a commodity, but as a currency play? Investor demand is a critical element in the price of gold moving higher. And as a greater number of people around the globe are suspicious that their government or monetary authorities are in an inflate or die mode, they are moving to gold as a currency alternative and as an insurance policy of first resort. A third element pressuring the price of gold higher is a massive change in sentiment among central banks. If you ask a central banker what they think about gold, they still think it is anachronistic and unimportant to the role and work of a central banker. But what we're seeing in action, not necessarily in word, is a shift back in the direction of buying. 2009 was the first time in a long time that we saw net purchases of gold by central banks versus liquidations. As the IMF has brought hundreds of tons of gold to the market, they've been snapped up by central bankers, mostly in Asian countries. This is an important theme to realize. Whereas the 1980s, 90s, and 2000s were marked by liquidations, massive liquidations of central bank gold hoards, and that was a major element in suppressing the price of gold, now we're seeing massive acquisitions, which is one of the reasons why the price has moved higher and will continue to. Why would any central banker choose gold over a more productive asset, something that gives him an income stream, something that pays him interest or a dividend? It's because they're looking at the balance sheet of all those countries that they can choose from, sovereign paper, corporate paper, etc., and they're realizing that there is so much balance sheet frailty, as we've discussed throughout this presentation, that they need to do something else, if nothing else, to hedge their bets, if nothing else, to have a currency alternative, if nothing else, to ensure the survival of their asset base and be able to answer to their citizenry that they had done something responsible as prudent managers of those assets. The fourth element, and this is critical, there is a currency crisis looming. We've seen in 2010 the euro come under tremendous pressure because you look at Greece, you look at Spain, you look at Portugal, you look at Italy, you look at Ireland, and these are countries in shambles. These are countries that have balance sheets with more debt than equity, and in terms of being able to pay the bills, are facing the same kinds of crises we have here in the United States, whether it's California, Arizona, Nevada, Illinois, Florida. A growing number of decision makers are being faced with this issue. They don't have enough money to pay their bills, and they don't have enough of an income stream from their tax base to get ahead of the debts they've already accrued and continue to add to the stock of debts. We have a currency crisis looming, and that is absolutely critical. Let's look at a few elements of that. What we know from history is that all fiat currencies, that is, a currency without any backing, any asset backing it, fails. It's not as if there's been some grand innovation in money. In fact, fiat money has been experimented with for 5,000 years. And each time, what you find is that governments take advantage of the ease with which it can be made. They find themselves caught in corruption, buying votes with this money, which is so easy to print, and ultimately destroy that particular culture. We have, in the post-1971 period, an entirely fiat money system. And we're not talking about the US, we're not talking about Europe, we're talking about on a global basis. There's two things that can bring about the demise of a fiat currency. One is a crisis of confidence, and the other is some sort of military conflict. These two things we have either present tense or immediately on the horizon. Last of all, the fifth element that's driving the price of gold to significantly higher levels is that we have yet to enter into the manic phase of a gold bull market. Expect to see a radical move in gold over the next 24 to 36 months. We are on the cusp of an explosive move, the kind of thing that you only see once in a generation. To understand where we're going next, it's important to understand, I think, the three phases of any bull market, whether it's real estate, whether it's stocks, commodities. In this case, gold and silver in particular, the first phase of a bull market is marked by far-sighted mavericks coming into the market. That really, for gold and silver, was 2001, 2002, 2003, maybe even 2004. Then we entered into the second stage. Institutions and Wall Street as a whole begins to take an interest. They are interested in something in the market causing a significant move in a particular asset class and getting in just in advance of that. We began to see a proliferation of gold-oriented mutual funds, exchange-traded funds, things that would serve eventually as the vehicles for the mass public to come into that market, they were being created between 2004 and 2008. I think we are at the end of stage 2 and on the cusp of stage 3, the manic phase of the gold bull market. I think we can now anticipate an interesting shift as the general public, the man in the street, comes into the market. That transition between phase 2 and phase 3, I think will cover the next 6 to 12 months. Anything above 1,500 in the gold price, and we're entering into that last manic phase, which may last an additional 12 to 36 months. Today we estimate that less than 2% of Americans own gold or silver in any form or fashion. That number, if it expands to 3 or 4 or 5%, will be significant. But the greater audience for gold in today's bull market is a global audience who's looking at global imbalances, who are looking and experiencing a global recession, who are watching their monetary authorities, contrary to what we see in the United States, already beginning to fight inflation. The rise of interest rates globally is already happening. We're just a little late to that particular game. Hopefully our citizenry is not late to the gold bull market, not too late. As an organization, we've highlighted the problems in the financial system, the economy, the political arena, and potential unintended consequences into the geopolitical sphere. And we've done this not just this year, but in the past. We've put together DVDs which have helped shed light and given direction and guidance to investors. And beyond our DVD projects, we have published our work in print for over 30 years. We've put it in audio form on our website for the last 2.5 years in the form of a 30-minute audio commentary. Why are we doing what we're doing? It doesn't matter that politicians and central bankers are at the margin of this move. The people who are central are people like you and me, and they're saying to themselves, we're not comfortable with what's happening in politics, we're not comfortable with what's happened in the economy, and it just makes sense to insure. It's been our observation over the last 3 years that the number of clients coming to us who are looking at significant purchases of precious metals is increasing dramatically. There is no reason to have great confidence in the market today. There is no reason to put confidence in the policies that are being crafted today and implemented tomorrow. So the asset class is not viewed as a speculative long position with the hope that you might profit from it. It is viewed as an unfortunate decision which has to be made today in order to ensure against the bad decisions that someone else is making that will impact you directly. The question is, have you put together a strategy, an exit strategy, which will help you take advantage of this price move and prudently and judiciously move to the sideline with a certain percentage of those gold holdings? This is the value that International Collectors Associates, a part of the McIlvanney Financial Group, adds. We know what to look for. We've done this before. We've been through bull and bear markets in the metals and in every other asset class. If you are not partnered with someone who is integrous and competent, that is the invitation we're offering to you today. Our group, the McIlvanney Financial Group, was put together, the component parts to complement a holistic strategy for wealth management, not only asset preservation, but conservative growth over time. The invitation to you today is to consider what that relationship would look like. How would you engage us, either for the risk management and insurance portion of your asset base, or the active management of stocks, bonds, currencies, and a variety of other asset classes? You'll find the specific teams within the McIlvanney Financial Group more than able to meet the individual and family needs that you put in front of us.